Will investing in the HDFC Life Smart Protect Plan help you in your wealth creation journey or not? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a non-participating individual life unit linked insurance plan. Some of the key features of the policy are you get premium payment options of limited pay and regular pay, and you have the option to choose a cover that fits your needs and maximizes your benefits with 4 plan options, and there is a choice of 10 fund options with unlimited free switching, and you also have the option to reduce your death benefit after a chosen period under decreasing cover and decreasing cover with capital guarantee plan options, and you get minimum assured benefit on maturity under level cover with capital guarantee and decreasing cover with capital guarantee plan options. And some of the charges that they make you pay in this policy are written during the policy term itself. As I have previously mentioned, this policy offers 4 plan options that you can choose from depending on your protection and savings needs. So they are option A, level cover, option B, level cover with capital guarantee, option C, decreasing cover, and option D, decreasing cover with capital guarantee. And there are also 10 fund options for you to choose from. So they are diversified equity fund, bond fund, discovery fund, equity advantage fund, sustainable equity fund, flexi cap fund, mid cap momentum fund, nifty alpha 30 fund, top 500 momentum 50 fund, and dynamic advantage fund. As you can see, all these fund options are presented on the screen with a tabular column indicating how much percentage of allocation each fund option has to certain asset classes. For example, like money market, which includes cash and deposits, and also government securities, fixed income, bonds, and equity. And they are also categorized based on the risk profile each fund option has. Like it can range from moderate to very high. And how much fund option you can allocate your premium to depends on what kind of plan option you have opted for in the inception of the policy. And there are also benefits like death benefit and maturity benefit, which all differs based on the plan option you have opted for. And it has another benefit like loyalty additions. So this product offers a return of 2 to 3 times your mortality charges, and return of 2x of your premium allocation charge, and return of your fund management charges excluding taxes, and also they return 2x of your investment guarantee charges. And they also have other benefits like switching, premium redirection, partial withdrawal, top-up premium, settlement option, and you also get the option to reduce your sum assured. But still, much as benefits are there are also certain various charges that you need to pay for investing in this policy. Charges like premium allocation charge, policy administration charge, fund management charge, mortality charge, investment guarantee charge, and discontinuance charge. But there are no charges for partial withdrawal, switching, premium redirection, and miscellaneous charges. But the thing is, most of the market linked products levy charges just to manage the fund. But here there are some extra charges like investment guarantee charge, discontinuance charge, etc. These charges will bring down the return in the long run because they are deducting these charges from your net premium. So before investing your premium in fund options they have given to you, they will first deduct it, then only they will invest it. So in the long run it will impact your returns because the capital itself is getting deducted. Now let's take a look at the advantages and disadvantages of investing in this fund. So the advantages are the policy offers a wide range of plan options like decreasing cover and capital guarantee, and the plan returns some of the charges like mortality charges, fund management charges, and investment guarantee charges within the policy term itself. And you also get top-up premiums which increases your fund value. So you get to top up your premium to increase your fund value. And there is no partial withdrawal charge, switching charge, premium redirection charge and miscellaneous charges present in this policy. And you can even add riders to your base policy to enhance its value. So these are some advantages. The disadvantages are there is no loan option available in this policy. And although the plan returns some of the charges, it doesn't consider the time value of your money. And the lock-in period is also 5 years for partial withdrawal or surrendering this policy. And some of the extra benefits available under this policy are available only under certain plan options only and not applicable to every other option present in this policy. So you need to keep these drawbacks in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to analyze the internal rate of return (IRR) of this policy to get an idea of what our actual returns are going to be if we choose to invest in this policy. So we are going to conduct this analysis based on the figures mentioned in the policy brochure. And if you want to know more in-depth details about each benefit and how they play into this policy, you can always refer to the policy brochure. Now, for calculation purpose, let us assume that a 30-year-old male buys this policy and under the option A level cover option. So the sum assured is 1 crore and the annual premium is 1 lakh. The premium paying term is 10 years and the policy term is 25 years. So we are going to calculate the maturity benefit and the IRR based on the assumed future rate of returns like 4% and 8%. So this is just to indicate the worst and best case scenario this policy can end up in. These are not guaranteed returns and they are not the upper or lower limits of what you might get back from this policy, because the value of the policy is dependent on several factors including the future investment performance. This is just to give you an idea about how this policy can give you returns based on this worst and best case scenario. So if the policy holder pays the premium regularly, at the end of 25 years he would be receiving the fund value. So here the fund value at 4% is 15.11 lakhs and at 8% it is 32.37 lakhs, and the IRR for 4% is just 2.03%. That's the percentage of return you will get in your hand, and which is not even comparable to a savings bank account rate of interest. And if you look at the IRR for the 8% return, this is 5.83%, and it's also not comparable to fixed income instruments itself. So this is a long-term investment. So keep in mind, this is a long-term investment of 25 years of policy term, but the IRR doesn't hold good for a long-term investment like this. So under this policy, the fund value at the end of 25 years won't be sufficient to fulfill the inflated cost of your financial goal, because any long-term investment should combat inflation, but the potential return from this policy is less than the inflation rate. So in order to fulfill your financial goals, there are other products available in the market which yields better return and also offers better liquidity with good fund performance. So let's conduct a comparative analysis with an alternative strategy where instead of coupling insurance and investment, you're going to invest in it separately by allocating the same premium we used in HDFC efficiently in these separate components. For comparison purpose, all the metric like the sum assured and policy term is assumed similar to the HDFC life policy's example. So the annual premium in the example HDFC policy was 1 lakh, but here we can utilize this entire amount for both life cover and invest separately for our life goals also. So for life insurance purpose, we have chosen a pure term insurance policy for a sum assured of 1 crore, which would only cost us the annual premium of 17,300 rupees. So the policy term is 25 years and the premium paying term is 10 years. So the balance amount of 82,700 rupees could be utilized for investment purpose. So here for the example purpose, just to give an idea of both how a risk-free instrument performs and how a high-risk instrument performs, we have chosen one risk-free instrument like PPF and one high-risk instrument like ELSS for investment purpose. You can choose any product of your choice based on your risk appetite. So here in the case of PPF plus term insurance combination, you can see that PPF has a lock-in period of 15 years with a minimum contribution of 500 rupees rupees per year. So as we have assumed a premium paying term of only 10 years, adjustments were made in the last 5 years contribution, where we contributed a minimum of 500 rupees per year just to keep the investment going. And here in ELSS, the redemptions are taxable. So the capital gains tax is worked out and the post-tax value is taken for our IRR calculation. And if you're wondering how the ELSS tax calculation is made, we have also presented a small tabular column on the screen for your reference, which you can look at and pause it. So the tax calculation is given in the screen, which you can pause for your reference. Now moving on, the IRR of the 8% scenario under the HDFC policy for pure term plus PPF seems to be the same, because it also comes around 6.14%. So similarly you can say, but in the case of HDFC, it invests in the equity market, whereas PPF is a debt instrument. So it is not a fair comparison, because if you look at it, PPF is giving the same returns for a much lower risk and it is a guaranteed return, and HDFC is not able to match with even the debt instrument return. And if you take a look at the IRR for pure term plus ELSS combination, it is 10.39%, which is calculated on the post-tax return. So this will help you in achieving the goals, as the return is much higher than the inflation rate. So what is the final verdict? Is investing in the HDFC Life Smart Protect plan worth it or not? This policy provides the dual benefit of life insurance coverage and investment growth. A portion of the premium paid goes towards providing life insurance protection, while the remaining amount is invested in the chosen investment vehicle. So it offers flexibility in terms of investment choices. Policyholders can select from various investment funds based on their risk appetite and financial goals. Like most policies in the bazaar, it's important to note that these ULIPs comes with certain charges, including premium allocation, policy administration, fund management, investment strategy and mortality charges. And only a few charges are returned and added back to the fund without considering the time value of your money. This 100 rupees you have now will not have the same value in 10 years. So think about it. And these charges will eventually pull down your potential return as well. So alternatively, you can opt for a pure term insurance policy for life cover and invest separately for your life goals, which is the best viable option. And you can build an investment portfolio which is diversified to meet all your goals. And moreover, to combat inflation in the long run, investing in a well diversified portfolio is more important. So it is advisable to thoroughly understand the policy terms, charges and investment options before investing in a ULIP.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.